You're watching Closing Bell with me, Lavisha Darad, and the color continues to be red for the Lal Street, given that the West Asia conflict, it's not seeing any respite as of now. But yes, we've seen that US President Donald Trump has said that he will be prepared to talk and resolve the conflict, but he's also added the fact that the 4-week military operation could be possible against Iran. Iran too has retaliated and said that they will be not negotiating at the current juncture. But yes, as of now, around 3 tankers have been bombed along the Strait of Hormuz. Iranian officials have already warned that no ships will be passed through the route, and that is why the street sentiment has been well capturing all of these news developments that has been happening. If you look at the Sensex and Nifty levels, Sensex is down by about 1,000 points. It's well off the day's low, but yes, Nifty is still down by about 300 points below that 24,800, around that 24,900 odd levels as well. But yes, sectorally, it has been an absolute bloodbath. If you look at majority of the sectoral indices have been reeling under pressure, particularly for the sectors that are exposed to the Middle East. For instance, we did see rice stocks taking a nosedive today. If you pull up the charts of LT Foods, KRBL, all of these counters have been remaining under pressure today. But yes, other than that, you can see Nifty Metal Index has been rejoicing. You can see 0.3% gains coming in on for the Nifty Metal Index. Hindustan Copper has been doing well. Vedanta, Hindustan Zinc, they are some of the other gainers on the metal index. So yes, metal stocks definitely performing well. But yes, apart from that, we've seen stocks that have significant exposure to the Middle East. For instance, your L&T, Wartech, Wabag, all of these particular counters have seen and have come under the selling pressure. But yes, crude-sensitive stocks, they particularly, continue to draw the limelight. If you look at the OMC names, they have also been under pressure. Paints, tire stocks, CEAT, JK Tire, Asian Paints, Burjaj Paints. If we pull up the charts, you'll see that all of these counters have been reeling under pressure. But it's not just that. We've seen that the European markets have also opened on a negative note. And even for the fact of the Dow futures has extended the sell-off to about 600 points. Downtake is coming in from the global end of the markets too. But yes, let's quickly take a look at how the gainers and losers pan out for the markets as of now. If you look at the gainers list, quite a few stocks have come up in the gainers list. But yes, you can see ONGC has been doing well with about 1% gains. Sun Pharma has done well with about 0.9% gains. Bharat Electronics, of course, we have seen that defense stocks have been doing well, given that the ongoing geopolitical tension. So Bharat Electronics on the back of that. Hindalco has also been doing well. Aluminium prices that rose by about 2% on the LME index, which is why we are seeing that Hindalco has also been doing well. But yes, among the losers, what has not done well in today's market, you can see L&T, one of the biggest casualty of today, nearly 5% downtick coming in for there as well. You can see other than that, you can see aviation stocks have not done well. Indigo, for instance, that has been reeling under pressure as of now. Maruti Suzuki with about 3% decline. Bajaj Auto, some of the auto stocks have also come under the radar. Bajaj Auto, Eicher Motors, all of them seeing a decline of about nearly 2 to 3% itself. But yes, it's been a red across the screen, and just ahead of Holi, we have seen that the markets have been totally, in the color of red as of now. Surbi, I'll go across to my colleague Surbi Upadhyay is joining from the Mumbai studios to understand, how the market texture looks like at this current juncture. Surbi, clearly, it's a bloodbath and it's a market meltdown for today. If you look at the advanced decline ratio, that still stands at about 1:5. What are you making sense?
Yeah, absolutely, Lavisha. I think we've all been trying to make sense of this day, the moves that we've seen. And I think it was always coming. I was hearing your conversation with your guests also earlier. And absolutely, I think there's no surprise here. But the sense that I picked up, speaking to a couple of experts out there and a couple of traders out there, is that the reason why the market at least has inched higher in the last half an hour, 40 minutes or so, could be twofold. That, you have the Nifty weekly expiry on Tuesdays usually. Tomorrow is Tuesday and it's a holiday, it's Holi. So we could have, the earlier positions and that expiry play out today. A lot of those positions perhaps are covering up. And also perhaps a lot of the more aggressive shorts may not want to go in to this one-day holiday, keeping those positions open. Shorts have made money. They've anyway made money over Friday, over, so far this Monday. So maybe some of those short trades are also covering as people close those positions and then take a fresh call, fresh guard come Wednesday. And we don't know. I mean, it's such a fast-moving screen. Who's to say what comes out. We can only hope that by the time we come back to trade on Wednesday morning, things have kind of at least de-escalated to some extent or not. But otherwise, Lavisha, I think it's risk off. It's very, very clear. It's playing out across sectors, barring the Nifty Defense Index, which was trying to, throw some little hint of green. I think it's not quite successful. Last I checked, it was also in the negative territory. It was down. Every other sector has been down. So it's an overall risk or risk off move. But what's interesting is that for whatever it's worth, and I'm guessing purely based on technical factors, the market has made a very, very smart recovery from the lowest levels. We were at 24,600 thereabouts, earlier in the afternoon. From there, it's looking a lot better. But who's to say where this goes? Because there is no sign of de-escalation. That Saudi Aramco refinery getting hit, that was big news. I mean, it was a drone attack. It wasn't a missile attack. The Saudis are saying they've contained the damage. It's not too much. But it just tells you that, aggressive moves are still underway. The Iranian ministers have been saying, the ones who are in charge now, they've been saying they do not want to enter into negotiations with the US. It's also a lot of optics. I think perhaps it will go on for a couple of days till there is some sort of a cool off, some off ramp as it's called, and some kind of talks start. But as of now, it's still very, very tentative. And you're seeing that the market turned very nimble, even in a lot of the oil stocks. Take ONGC, for example. ONGC had a great rally in the past couple of days. This morning, the stock opened higher. But I guess even there, people were very quick to take profits on that long trade, the few long trades that are working. So therefore, I think it's just nimble trading that we're seeing and cautious trading. And maybe that's exactly what is needed in markets like these. Lavisha.
Got it. Yes, Surbi. Of course, we have seen that in the last few weeks, we have the AI scare, which actually crippled the markets. And now we have another doldrum for the markets to understand. That's the geopolitical tensions, which is taking place in the Middle East. But Surbi, I mean, we have seen that, in the past, we have seen that Russia-Ukraine war, when it had taken place, that was one of the biggest war that happened in Europe. And we saw that Nifty had fallen to about 17,000 levels. And since then, we have recovered quite smartly. So it could be possible that, this is just a sentimental reaction which is going to take place for a temporary bit. But eventually, investors are once again going to digest this eventually.
So the big difference between Russia, Ukraine and this particular flashpoint is that it's far more real for us here in India, Lavisha. Russia, Ukraine, actually the world stopped buying Russian oil. We started buying cheap Russian oil. So in effect, it actually turned out a little positive for us, purely in terms of economics. But here, the choking of the Strait of Hormuz has become the biggest issue for commodities across the world, for oil, for gas. 20% of the world's oil flows through that strait. About 20-25% of the world's LNG flows through that strait. And let's not forget that according to most estimates, almost half our monthly requirement of crude oil is transiting through the Strait of Hormuz. Right now, effectively, the Iranians haven't issued a statement on that shutdown, but ships are simply not transiting. And why would they? Given the risk premiums involved and given the kind of uncertainties involved. So therefore, this is not just a sentiment hit and a market situation or a market issue for India. It's a very, very real economy issue for India as well, because that is an important transit point for us. Now, I think we have a couple of meetings lined up in Delhi today across ministries to take stock of the situation, to take assessment of what is our strategic reserves position like, petroleum reserves. And, and the thinking right now again seems to be in markets, in corridors of policy and power, that they should resolve over the next couple of days. But if this doesn't, then we're looking at a very, very real situation for global markets, for India in specific, because this becomes a very big question on energy security. Right now, no one's kind of working with that base case. But every time you're seeing a fresh strike, I mean, the oil markets opened with a 13% gap down, or gap up rather. And then by the time our trade kind of kicked off around 9:30 or so, markets had cooled off. The gain was only 5% on oil prices. And now the gain is again about 8% on oil prices. So every time there is a drone strike or a missile strike at an oil installation or at an oil tanker that's somewhere in that region, you're seeing the risk premium build up. So no, it's not over. It is very, very significant and serious. Markets, you're right. I mean, otherwise, markets have ignored what happened in Venezuela. Markets have completely ignored what happened in Gaza. I mean, the war that was raging between Israel and Hamas. So markets have ignored all kinds of geopolitics and moved on. However, this time it's about oil, And oil is as strategic to markets as it is to consumers. And therefore, this is not something that can be sort of written off in a hurry. One can only hope that there is de-escalation and that lives are not lost and that the strait is allowed to function, that oil tankers can start transiting again. Not just oil tankers, even product tankers, containers, because so much of our shipment, our rice exports, etc., all of that transits through the Gulf. So this is far more real in terms of the potential implications and impacts. So fingers crossed, hoping this plays out. And just one last point, Lavisha, you spoke about risk aversion and the markets have been dealing with a lot. Absolutely. The markets had, all of February to deal with AI, and March starts with a full-blown geopolitical conflict. I'll watch out for what US bonds do tonight, because there were anyway inflation fears in the US on Friday, because we had that producer price inflation report, the PPI numbers, and inflation was very, very, elevated compared to estimates. And we anyway saw that rush towards US bonds, yields were dropping. And now we have this added geopolitical situation. So let's see how US investors behave. Futures right now are indicating that markets will open down about 0.5% to 1%, and then we'll pick it up from there.
That's quite interesting. All right, Subhi, with that, we have to let you go. But thank you so much for joining us. All right, let's quickly go across to my technical expert of the show who's joining us to at least decode what the market sentiment looks like. Joining me is Ajit Mishra of Religare Broking. Ajit, earlier we were talking to Surbhi about the same, about how the geopolitical tensions have been unfolding and how the market reaction has been. I mean, considering the drop that we have seen today on the index level, do you think that if in case the war actually goes and further there's an escalation from here on, do you think that Nifty could actually test 24,000 levels?
Yeah, good afternoon, Lavisha. So, Lavisha, I was hearing your conversation with Surbi, and the first thing that comes across, especially when it comes to the area where we are seeing this situation. So, when it comes to Middle East, everybody consider about the oil prices. So, oil prices, if you see that from around $40 to $58 is something that we've seen a decline, and now we were seeing that it's been almost a couple of quarters we were hovering in this 70-75 band. After this event unfolded, we are seeing that again we are inching towards 80 plus soon. So that definitely is a big concern for markets like us who are largely dependent on crude imports. And but at the same time, when it comes to the market positioning, Lavisha, the gap that we had post the US-India trade deal, we have had discussions around this that eventually such kind of gaps usually get filled. Friday we had kind of an indication, though it could be multiple reasons. Means Nifty slipped below the long-term averages. It was MSCI rebalancing, but somehow it was kind of a precursor that something is going to happen. And today we have not only filled that gap, but we have also retested the February month low close to around 24,570, 580 area. So we are testing that zone for third time now in the last 5-6 months. And in case if Nifty fails to hold this area, then probably yes, 24,400, 24,200, 24,000, all these levels are possible. So as of now, 24,600 is something that we believe is going to be a critical zone to watch out for. And to stabilize the market, we need to reclaim 25,200, 300 decisively.
Okay, got it. Ajit, let's talk about quickly about some individual movers of the day. L&T, clearly it's one of the day's biggest casualty, given that the company's international order book is hugely exposed to the Saudi Arabia, UAE regions. Now, given that the stock already saw quite a good February month, do you think that March is just the beginning of the consolidation phase for L&T?
In fact, I feel otherwise. Means, Lavisha, it was almost like 1.5 years of consolidation, which recently ended, and we are again re-entering into this consolidation zone. Means we have retested the neckline area. We have penetrated the same, in fact, in today's trade. So it seems like more of further consolidation with a positive bias. So it's not that outrightly we have seen the tone completely shifting from positive to negative. So yes, there could be more of consolidation, time-wise correction in the stock, but a zone closer to around 3850, 3900, we have multiple supports to look at. So in case somebody is looking for a long-term perspective, they can start accumulating even at current levels.
Got it, got it. All right, Ajit, let's also talk about the crude sensitive, since in the past 3 days we have seen that Brent has already risen by about 10 to 12%, and it spells trouble for OMC, paint and tire stocks, and that's well reflected in today's stock movement as well. For you, any of these crude sensitives look attractive from a near term or a medium term perspective?
Tire stocks, they were doing well. In fact, we were seeing that JK Tires was quoting at the record highs, a couple of weeks ago, and now we are seeing a bit of a profit taking. But overall trend looks positive to us. Uh, Paint definitely looks weak. Means if you see that Asian Paint after this attempt of recovery and then this consolidation range breakdown, this indicates a possibility of further decline towards 2200 and below. So paint counter is definitely something that you should avoid. Tire counter selectively one can look for accumulation.
Okay, got it, got it. All right, on the flip side, but we have seen a good rally that is coming in upstream oil explorers. For instance, ONGC has been doing well. Oil India has also relatively fared well because of the higher crude prices benefiting their top line. Ajit, how do you see all of these from a technical angle, ONGC, Oil India?
Oil India definitely looks very promising. Means after almost like 1 year of consolidation, we are finally seeing that the stock has stabilized around 450 area after forming a base around that zone, and we are gradually seeing recovery also. And indications are in the favor that in the near term, 520, 540 is something that the stock might test. So even at current levels, it looks okay to accumulate with 405 as a closing stop loss for Oil India.
Okay, all right. That's the view for Oil India as well. Ajit, just one last question before we let you go. Any top picks you want to highlight at this particular market meltdown that we are seeing at the current juncture?
Yeah, so Lavisha, within the defense space, BEL is one of the consistent name, means the stock is still holding around this record high, irrespective of what we are seeing in the market scenario. It's maintaining the positive tone while holding above the short-term averages. So this gives us comfort that once the market stabilizes, we are set for the next leg of the up move also. So here one can look for fresh long position even at current levels, and your stop should be at 442. 474 is what we are eyeing as a target. And like what we've shared about paint counters still, looking wobbly. Asian paint can be considered for fresh shorting even at current levels after this decline. So 2200 is the near-term target. So with stop at 2380, one can go short in Asian paints.
Okay, all right. That's the word coming in. And those are the top picks. All right. With that, we have to let you go, Ajit. But thank you so much for your time and joining us.
Thank you.
All right, let's quickly address how the rates have fared for today's market. If you look at the close, Sensex is down by about 1,000 points. Nifty is also down by about 300 points. Below that, 24,900 odd levels. Of course, we've seen a bit of recovery from the day's low. But yes, Nifty has extended the loss to about the second consecutive day. Of course, it's a risk-off sentiment, not just for our own markets, but of course, the global markets have also been reeling under pressure, given how the Mid-East conflict has been faring at this current point. But India VIX has seen a quite a bit of a jump, 23% gains coming in for the India VIX, showcasing that clearly that the markets have been anxious, given that there is an uncertainty in terms of the geopolitical developments. But yes, from a sectoral perspective, we have seen that defensives have taken an upper hand. Pharma's index has ended in the green. But yes, the metal index is also showcasing a bit of a positive bias, ending with about 0.2% gains. But other than that, a majority of the sectoral indices have succumbed to the selling pressure and have ended in the red. But yes, apart from that, you can see Bank Nifty also ending in the red with about a percent loss. Realty index with about 1.5% loss coming in for there as well. IT index, which was up for the past 3 consecutive sessions, today they have snapped its 3-day winning streak and have ended in the red with about a percent loss as well. But yes, let's take a check of how the top gainers and losers look like on the Nifty 50 index, given the kind of broad-based sell-off we have seen in the markets. So you can see about 8 advances versus 42 declines on the Nifty 50 index. But yes, what has done well in this market is your Dr. Reddy's is seeing a bit of a buying interest, ending in the green. Other than that, you can see Sun Pharma also doing well with about 15% gains, 0.8% gains coming in for Sun Pharma as well. ITC also doing well with about a percent gains. So all of these three counters have done well and are one of the top Nifty gainers. You can see ONGC also doing well. Other than that, you can see Cipla also remaining one of the top Nifty gainers. Hindalco with about 1.5% gains coming in for there as well. Sun Pharma, ITC, and you can see Bharat Electronics, all of these counters have done well and remain the top Nifty gainers at the current juncture. But yes, so what is not done well in this market? Clearly, it looks like SBI Life, Interglobe Aviation, L&T, all of the aviation stocks have taken a hit today, given that the Dubai airport has been a lot of flights have a lot of Indian flights have been cancelled at the current juncture. Adani Ports also seeing a loss of about 50 points, 3.5% gains, 3.5% cut coming in for there as well. You can see other top losers. Bajaj Auto has not done well. Geo Financial, Power Grid, HUL, some of the other losers on the Nifty 50 index. But yes, to understand about markets and of course where we are headed, let's quickly get on board with our next guest of the show. We have market expert Ajay Bagga joining us to understand and to make sense of how the markets have reacted. Ajay, good afternoon. Of course, given the kind of markets we've seen today, it's a clearly market meltdown. Amidst all of these geopolitical tensions and of course the new world order that we have woken up to, how much do you think the risk premium and the war risk premium is already in the price, and how much volatility is more left?
Well, India VIX went up by 30%. So that is showing that expectation is of a very elevated volatility going ahead. How much is in the price? I think this was an expected event for the last 3 weeks. Finally, the event happened. And I think we got off quite okay. On a daily basis, a 1% move is not that big of a deal. And if you look at the closing prices, Nifty down 1.2%, 1.3%, we would take that any day. So not that big a damage as was expected, seeing the way things were panning out on Saturday and Sunday. What that is showing is that Friday sell-off had discounted some of this already. Morning, there was a sharp sell-off in the Indian markets. Pre-open, Sensex was down 3,000 points. At the peak, it was down about 1,600, 1,700 points. But then the markets have recovered by the end. So probably some follow-on buying has happened towards the end of the market session. So overall, I think we got off quite okay today.
Okay, got it. Ajay sir, I mean, the critical talking point has been the Strait of Hormuz, given around 50 to 60% of oil supplies might get stuck for India also. Now we also have reports saying that 3 oil tankers have been attacked, and Iranian officials, they have also warned tankers to not pass through the strait. Now, if there's a sense of prolonged conflict, what does this mean for crude prices? We have some estimates that today where Barclays estimated that Brent can touch about $100 per barrel if the conflict gets prolonged for a greater period of time.
Yeah, we have to see about 20 million barrels used to be supplied through the Strait of Hormuz via tankers. Now, out of that, about 10 to 12 million barrels are being diverted. One by the Saudi pipeline, which runs into the Red Sea mouth. And the second is the Abu Dhabi pipeline, which opens in the Gulf of Oman. So about 12 million barrels will be diverted there. 8 million barrels is the loss to the world on a daily basis, on a sustainable basis, if Strait of Hormuz stays closed. So we will not see that big an impact for the first few days because nearly about 200 million barrels are on the high seas in ships already en route. But in the next 3-4 days, if this doesn't get resolved, you will see a sharper spike in oil prices. Today, markets opened up 12 to 13% in terms of the oil price in Tokyo trading. And then it fell under 5%, close around 5% up. So markets have taken it in their stride. A lot of that, what you called the risk premia or the geopolitical premia, is already baked in. About $8 to $10 was in the price as far as Brent goes. Now, I would say another $5 to $7 has got baked in today. From here, a lot will depend on the scale of the war, the duration of the war, and if actually Strait of Hormuz closure is implemented by Iran. So far, officially, they have said, no, we are not asking anybody not to transit. A few Chinese tankers have gone through, but Japan has pulled out its ships. Europeans are not ready to put their ships in. So you are looking at about an 8 million barrel disruption. For India, out of that, how much can we buy from the Russians? That will be a big question. And second will be, can we get some of it out from the Gulf of Oman? So that will be the scrambling that must be happening by the Indian refiners. But definitely, if this stays on for a week or so, $100 price is not off the table.
Okay, got it, got it. Ajay sir, today we've also seen some of the stocks that have exposure to Middle East got affected. For instance, we had L&T, Wartech, Wabag, all of them, they have projects or order books from all of these reasons. I mean, how do you suggest investors to go about all of these companies which have some exposure to the Middle East?
See, fundamentally very good companies, and they will get even more reconstruction projects. In fact, Indian defense companies will get new contracts because the GCC states have woken up to the reality that A, they are very near to Iran geographically. Second, they are being held to ransom by Iran, despite them making it very clear that they have not offered their territory or their airspace to the Americans to launch any attack on Iran. That's why this attack got delayed, because the Arabians were not ready to host any American aggression on Iran. They thought that good conduct will get them a free pass from the Iranians. The Iranians have chosen to bring them into the conflict. So on the negotiation table, they have one more card against Trump, the pressure from the Arabians. I think that's a grim reality they've woken up to. This is going to impact the trade in the region. It's going to impact the market sentiment, all the golden visas that people were taking. I know a lot of millionaires who migrated to Dubai because of the easy tax regime, because of the excellent facilities. But this kind of an existential doubt which has come in with this bombing by Iran, I think that is going to spoil sentiment, and there will be a lot of action from these states to build up their defenses, build up their infrastructure even more. So I would not be worried about our good companies who have got these contracts by bidding on a competitive basis. These contracts will come back. It's a matter of 1 week, 2 weeks that this war ends. Both sides don't have the appetite, and more crucially, they don't have the armament to sustain this beyond a couple of weeks at the outside. Already air defenses are degraded on both sides to a large extent. So they would not want deep damage to happen, especially to Arabia, and there'll be a lot of pressure on Trump by the Arabians to go and sort this out and come on the negotiation table. I'm expecting a week more at the most, and with a lot of rhetoric. So markets will move on the rhetoric with pronouncements like yesterday they said they would stab US in the heart and stuff like that. So rhetoric will continue. We have to see on the ground how lethal are the attacks. Today also, Saudi refinery, I spoke to a friend working in Saudi nearby, and he confirmed it was a small fire from the debris of drones, but very fact that drones were launched on a big Saudi refinery processing 550,000 barrels a day shows the intent of the Iranian regime. But the good thing is the air defense got it before it could inflict much damage. So those kind of things we have to watch out for. If those start reducing, then you know it's more rhetoric than on the ground issues happening. And then we'll be near to a negotiated settlement. Iranian regime will go for survival rather than ideology. That is my basic presumption, and that will help us to get some peace working in the next 2 weeks.
Got it, Ajay sir. Ajay sir, we have seen that defense stocks, they have seen a bit of a buying interest today in the subdued market. From a valuation point of view, are you finding them attractive at the current levels?
Again, it's the order books and the expectation of further orders. So we will become major exporters of defense. You are seeing that there is a huge shortage of key defense equipment around the world, and we are able to supply state-of-the-art equipment. So I think we will see these companies doing well. You are seeing cycles in them. 2, 3 months they do very well. Then 1 month there is a sell-off on valuation basis. The new orders come in, again they rise. So that's how we have to view them. If you are going into defense, it's a mega trend across the world, from Koreans to Europeans to LATAM defense companies. They are the top performing sector. The whole world is rearming. Start from Japan and go right up to Brazil. Everybody is putting in new orders. So you are well positioned in the sector. Valuations, I agree with you, are not cheap. But then the order books, as they keep going up, that helps to justify the valuations. It's not like a pie in the sky kind of valuation. Depends on the order books, and the markets run ahead of themselves in terms of valuations. But the order books are coming, and we have a very long runway of more order books coming, both domestically as well as for exports. So defense as a sector remains a buy, but keep a 3-year horizon.
Okay, all right. 3-year horizon for the defense sector. That's your suggestion. Ajay sir, we've seen that last couple of weeks, Indian IT sector has been seeing a lot of correction. Nifty IT index, for instance, last month, we've seen about 20 to 21%, declines. But from all the geopolitical noise, it largely remains insulated. Do you believe that we have baked in the worst case scenario of the AI scare in terms of the correction that has the Indian IT sector that has seen?
I think more correction is due. Again, they are very under-owned and invested in. So that way, you've not got much more to lose. What we have to see, which is happening with some of the foreign IT service companies and IT consultancies, they are showing multi-billion dollar AI application and engagement cash flows. So our companies have to show that. We have seen that they have been training their workforces on AI. They have been talking about tie-ups with AI majors. I think it's now the time is there. What basically we have to look at is all the expense in the AI. Who will be the beneficiary? Will it be the infrastructure creators or providers like the semiconductor companies? Will it be the use case companies who actually use this AI? Or will it be the middle companies like our IT services companies, which enable this infrastructure to translate into actual dollars in the use case companies? I think that case has to be established very strongly in the minds of the market before we can return to a buy on the IT companies. So maybe wait out a quarter more and see some traction on AI revenues, and then we'll be back in business. But definitely, they have the cash flows, they have the skill set, they have the ability to make use of this AI. The AI infrastructure providers like the data center companies, they're going to be the early gainers, but you're going to see a lot of capex being wasted there, and the returns on equity not being very high. A lot of obsolescence will come in. Our companies being footlight and being capital light will benefit, in fact, for being able to have that agility to bring in use cases across platforms rather than being tied down to data centers and very heavy capex.
Okay, got it, Ajay sir. Ajay sir, we have seen that today rupee has hit a 1-month low, and if indeed the strait remains closed, there are reports that suggest that we might even relook at US for buying oil. I mean, with that much higher prices compared to earlier of discounted prices that we were getting from Russia, do you think that it's going to affect our CAD and what it means for the rupee trends going forward?
Yeah, from here, every $10 increase in Brent means about 30 to 40 basis point increase in our current account deficit, about a 30 basis point increase in our CPI. If the price gets a pass through. If it doesn't, then it comes back as a fiscal deficit via the refining companies. It comes on the balance sheet of the country. And again, there's a squeeze on yield. So the rupee is reacting to all that. All the emerging market currencies were under pressure. In fact, the Bank Indonesia came out and said, we are actively intervening. They were trying to talk up the rupiah, which is less than 1% from its all-time low. So clearly central banks are intervening. I'm expecting a lot of calls within central banks to see and evoke some consensus on how to tackle this situation. Overall, there is safe haven buying. You've seen Swiss franc, Japanese yen, and dollar, all three safe haven currencies getting bid up, and the others are getting sold. So rupee is suffering from the EM pack, and it's also suffering from the India characteristics of what you described, the CAD going up and oil price having an impact. So that has to be borne. I don't think RBI will be able to do much more than what it's already doing.
Okay, got it. Just one last question before I let you go, Ajay sir. I mean, we've seen that gold and silver ETFs they've gained today on the back of the geopolitical tensions. But particularly for silver ETFs, last month they've seen a bit of a profit booking. How would you suggest investors to go about both of these asset classes? Because we've seen that silver ETFs was particularly not led by the physical demand, but more by Chinese demand buying, and of course some institutional demand also which came in for silver ETFs. Going ahead, how do you see both of these asset classes to pan out?
Gold will appreciate faster than silver because silver has 60% of industrial demand embedded in it. So if this prolongs and oil prices go up, there's a global slowdown leading to a global recession, silver will suffer. So the safe haven part of silver is there, but if you have to play a pure play safe haven, that is gold. So I would say gold first and silver second. Silver price here on, there is just too much interference institutionally. You have seen 2 times the COMEX has been shut down for an hour each time whenever there is a fast rise in the silver price. So there's too much interference happening. Otherwise, probably the silver price would have been higher than this. Gold is a pure play. I would say first gold, then silver. Silver, what you have right now, you can hold on, but don't expect much price appreciation for the next few months till we get clarity on the global growth. So it's more a play on global growth and shortage of silver as such, with EVs and renewables all leading to a huge outflow of silver, data centers needing a lot of silver. So all that demand, if it stays, then you will see the silver also moving up. But safe haven buying is gold, so stick with gold for that.
Okay, got it. All right. Stick with gold. That's the key takeaway as of now. But yes, with that, we have to let you go, Ajay sir. But thank you so much for joining us.
Thank you for having me. Thank you.
All right, that was Ajay Bagga for us. And now let's quickly dive into an earlier conversation of this morning by Peter Maguire, where he's talking about what the geopolitical tensions mean for the gold and the oil prices going ahead and whether they could escalate from here on or not. So quickly to tune in into this conversation.
I think best case scenario would be 70 and maybe $1 or $2 cheaper, but it'll be a point in time. I think it'll be a couple of weeks until it gets to that sort of level. And then from the worst case scenario, as far as intensifying all those ingredients, then you're going to see crude and Brent probably that $85 to $90 range, quite simply because from a disruption standpoint, and that's the unknown leading forward. If this was really going to unravel and be very, very dynamic, and you're talking huge amounts of military action on both sides, then you could probably, it'd be triple figures. I think gold's got more potential and it really shot to the upside. It was very, very dynamic in early trade. I think it was up the best part of $140, $150 there at one stage. went through 5,400. And I would think that it's got more momentum as this week rolls forward. There's a lot of ingredients that goes into the price of gold, and it may well take out its all-time high in this particular situation over the month of March. And when you're talking about nat gas, yes, the second largest supplier in the world being Qatar, the impact that has to the likes of India as far as LNG and so on, these are really monstrous issues that have just got to be either played out and seen from a timeline perspective, the impact that has naturally to price and to product. And if you can't get the product out, then naturally price will go and it will boom to the upside.
All right, that was Peter Maguire for us, taking us through what the oil and gold prices hold for us in the near term, and of course amidst this all the geopolitical noise. But with that, let's quickly dive in into this Moneycontrol's exclusive conversation with the SEBI chief Tuhin Kanta Pandey, where he said that there can be measures if needed to curb any speculative activity in the derivatives market. He was reiterating his journey in the past 1 year and of course what the actions and measures have been taken by the SEBI for the derivatives market so far as of now. So tune into this conversation.
One of the things of interest to everyone in the market has been the derivative related regulations. In the first 8 or 9 months, there were a bunch of changes that happened. Is this the level at which we sort of, rest, or do you see more need to curb speculative activity or excessive retail trading? Do you think there is more to be done?
So I think on the derivative markets, there's a particular concern was only around index options, short-dated options on expiry day, weekly options. The rest of the market, I think, is not of that concern. So in that market, of course, we had put it out, as you know, the full study reports saying the extent of losses, and that created actually a lot of awareness around why a whole set of people were actually coming to this market and not being successful in making profits, because actually this is a very complex market, and the way it was being sold out by the so-called influencers as a market to really make big money overnight. I think that particular education has been belied, and that was, I would say, miseducation. So that is also another action on our thing against such influencers who, without a registered investment advisor license, are trying to give this advice and propagating through various social media forums is another area of interest to us in terms of enforcement.
Right.
But having said that, we have taken some measures both in October 24 and May 25, a series of 6 measures in May 25, the last of it kicked in December. And we would like to see the impact of these measures and also look at the situation from the data point of view again. And then if we find that there is an intervention necessary, we will then explore pathways in consultation with industry how to do it.
Right. Because one of the things that, a lot of people have talked about is about raising the entry criteria for participants into the derivatives market. In some of the Western countries, you need to be, have a certain, certification or be an accredited investor to even participate in the derivatives market. Do you think something like that will be under consideration in SEBI, or do you think it will be retrograde? What are your thoughts?
So that will again depend upon what kind of analysis we come forward, in what way the measures have acted. And then it will be like exploring different pathways, which might include the pathways that you are suggesting, but they are not the only pathways.
Okay. So you're saying it is not necessary right now to put any entry criteria for derivatives market?
Not till we have deliberated on this issue and worked out the thing. We can't be doing flip-flopping. And we should move consistently data-based approach and consultative approach in this matter.
All right, that's all we have for this edition of Closing Bell. Markets clearly on a panic move today, and we'll get you all the developments which is happening today and tomorrow on the geopolitical front as well. But we'll meet you now on Wednesday. Until then, do have a happy Holi and, stay tuned to moneycontrol.com.